So I think we need to talk about this next upcoming stock market crash. Now, a lot of so-called experts believe this crash would have happened by now. If you asked anyone in mid 2022 or end of 2022, when was the crash going to come? When was the recession likely to come? They would have probably told you around May or June. That's what we were hearing a lot at the end of 2022. People were kind of expecting a lot of pain in the first half of 2023 and expecting things to get back to normal in the second half of 2023. And let me just tell you, the further we get into 2023, the more delusional this market seems and the more unsustainable the market seems as a whole. Now, we're heading into the summer with more potential worries, with more crises on the horizon. And a big one is going to be the debt ceiling. And that is a big reason why markets could fall over the next couple of months. But it does run a lot deeper than that. There could be pain for stocks ahead, and this could have implications for some of our favorite stocks to invest in here in the markets. I talked about that more in the last video. But in this video, I want to go over kind of current market expectations for different things and how inevitably this could be heading down the path towards a crash. So we're going to get into it. Hit the like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. So this just came out yesterday. And I was actually trying to find this note because it came across the newswire. I read a little bit of it. The markets were, doing their own thing. I was trading, I was making videos, doing whatever. And I lost the article, but I have found it again. So it says Goldman Sachs warns of volatility as quant traders pile in. Quant investors have swooped into equities as strong first quarter earnings and resilient growth in the US has kept a lid on volatility. The VIX has been below the $20 level since late March. This has pushed the exposure of systemic investors to above neutral for the first time since December 2021, according to Deutsche Bank calculations. This means that since December 2021, hedge funds and other players in this market, they've been neutral or short, right? Well, now investors are above neutral. So now they're actually exposed to an upside move in the markets, meaning that there's really not that much protection out there for a downside move. After all, a hedge fund is supposed to hedge different directions. And it seems like this time around, it's just in a couple of names, guys. Your Apples, your Microsofts, your Googles, your Amazons. Those are the stocks that have done very well so far in 2023. You either bet that they continue to do well, or you're making a bet that small and mid-cap companies catch up to those large mega cap companies, right? If they're up 35% in a year, something like an Apple, and something else like a Fubo still down 65%, 70% from a year ago, you better bet that Fubo goes higher because there's only so high Apple can go, right? So that just shows you the concentration of this market. You have stocks like Roku that are half of where they were trading at in 2019. You have stocks like PayPal that are half of what they were trading at in 2019. And a load of other names. Those are two household names that you guys can all be familiar with. And actually, the Russell 2000 is down year to date, whereas the NASDAQ is up 17%. That doesn't make sense. And that would be a very historical divergence if we go back into a bull market and the Russell is not outperforming, right? The Russell should outperform if this was truly the end of a bear market. That's not happening, right? So that's a big problem. And I think that is highly overlooked by a lot of analysts, right? A lot of banks, a lot of financial experts overlook that. You've never really seen a bull market start with the Dow or even the Nasdaq. It usually is your small and mid cap companies. Well, at least that is what history would show us from the past. Now, with that being said, there is a big risk here that markets are expecting too much from the Fed. And this is a very interesting dynamic, and I hope I put this into perspective correctly for you guys. The markets are expecting rate cuts. There will be no rate cuts without one, inflation falling off of a cliff in a way that we have not seen in a very long time, since the 80s. Or if there is some bad event, a black swan event, as it is called, something nobody foreshadows happening, that happens, that is a major risk to the financial system, to the economy, the labor market. Something like a COVID, or something like the United States defaulting on its debt, or getting a credit downgrade. Those would be really the only two things that would cause the Fed to cut rates as soon as markets are expecting. Okay? One of those could possibly happen, right? The United States could get a credit downgrade if we get closer to June 1st without any resolution on raising the debt limit. That's already happened before in the past. It happened in 2011, and the consequences were bad. That's just a credit downgrade. We raised the debt limit then. If we were to actually default, then forget everything that's said in this video. Stocks are down 40, 50, 60% or more from our current levels off the initial reaction. We probably wouldn't trade down there for a while. That's what would happen off the initial reaction, though. You would see the bond market freak out, stocks, it would be terrible, right? Even if you're bearish, you don't want that to happen. That has a lot of implications for the real economy. So those are the two things that would cause the Fed to cut rates, essentially by July, where markets are starting to expect a rate cut. But if those things don't happen, then this market is in a lot of trouble, because those top 10 stocks that have had 70, 80% of the rally weighting of the S&P 500, meaning that if you took those largest 10 stocks out of the S&P 500 and left 490 of the other names, the S&P would be up like 1% for 2023. The NASDAQ would be up like 4%, 3% for 2023, instead of 17% and almost 9% for the S&P. So it'd be a much different story. But why are these large companies rallying? These large tech companies specifically, your largest companies in the world? Well, it's because investors expect that the Fed's going to cut rates and valuations will get propped up again. Well, they've already propped those valuations up ahead of time, expecting the Fed to cut rates, when in all reality, their actual earnings are down, even Apple, 5-8% year over year. But you're at a higher valuation now with higher interest rates. So if we don't get that Fed cut, stocks are going to be in for a lot more pain. Now, why we get that Fed cut is more important than that, because if the Fed cuts rates because the economy's all of a sudden deteriorating, or there's a black swan event, that's not good. If inflation does magically come down, that is your soft landing scenario. And according to what we're seeing from the bond market and the Fed rate monitor tool, 42% of investors are expecting a cut by July 26th. That is what, like 60 days away, 50 days away, and we're expecting the Fed to cut rates. And then September, 28% of investors are expecting another rate cut. November 1st, 28% of investors are expecting another rate cut. So 3 rate cuts back to back is priced in on an average of about 33-ish percent. 33-ish percent that starting in July we get 3 back-to-back rate cuts. Let me tell you, based off of that scenario, stocks will go down. Now, will they go down tomorrow? Maybe, maybe not. 50-50. If we get close to June 1st and the debt ceiling situation does not get better, that is the big catalyst that can and likely will send down stocks if there is no movement. And right now, it doesn't look like there is any. And Janet Yellen coming out and sounding that worried is unlike what we've seen since 2011. Now, in 2011, the United States credit got downgraded on August 5th. This was not a default. Everyone got paid. Nobody, well, they did shut down parts of the government at this point. That's why you had the credit downgraded, because if you have to shut down the government, social services to pay bondholders to fund your debt, there is a huge problem there. Okay. So for rightfully so, we got our credit downgraded on August 5th, 2011. And it says right here that several credit rating agencies around the world have downgraded their credit ratings of U.S. federal government, including Standard & Poor's, which reduced the company's rating from AAA to AA plus on August 5th, 2011. Now we're back to that AAA rating, but things are eerily similar to where they were in 2011 as far as politically speaking. Now, this time around is even worse because for the last, 2 years now, Democrats have had control of everything. So Republicans really haven't been able to do anything. They haven't been able to veto anything. They haven't been able to make any, decisions on anything. Everything's got passed because they had the power they needed to do so. Well, now this is like the first thing Republicans have say in since they now have the majority, right? So it's going to be a showdown, and it might be a very egotistical showdown, and that's unfortunate for regular people. Trust me, if we defaulted, you would be affected. Hopefully you made a lot of money on the puts at that point because you would be negatively affected. Everyone would be. So it's not like this is a good thing. And it's a very big problem as of right now. Now, if we look at August 5th, when we actually did get our credit downgraded, this was on a Friday. And the markets were pretty flat. Negative 0.16%. You had fallen a lot in the beginning of the day, quite a bit. And you retraced all the way back up to almost go positive. And then the next trading day, which was that following Monday, the markets fell 6.51% that next day. 6.5% in a single day. It was rough. Very rough. From the peak before the sell-off to the low in 2011, dropped about 21-ish percent. Now, there's a lot of bad things going on right now that are a little bit different. You have a CPI problem. You have an CPI problem, an inflation problem. Inflation just came out today, and it's still 4.9% on the headline year over year. But on the month over month, the core CPI is up 0.4%. Showing almost 5% annualized pace of inflation. That's also a problem. Now, a recession would cure this, but anything with the debt limit, the debt ceiling is a problem. Long story short, the bond market right now, investors are expecting something bad to happen. That's why they're expecting 3 rate cuts with a 33% probability of 3 consecutive rate cuts. There's a 42% chance of a rate cut in July. Based off of a couple more data points or news headlines, this could very quickly go to 100% or go to 80% or be over 50%. And let me just tell you guys a little trick and tool. Whatever is priced in, the Fed is going to do within reason. Obviously, if things were like they are today, heading into July or September, when the markets are expecting rate cuts, if nothing is broken, if the markets are fine, if inflation is still like 4%, you're probably not going to get rate cuts. And the markets will change their expectations. But right now, it's pretty rough. It's pretty bad. The actual outlook from the bond market right now, because these probabilities of rate cuts or increases or a pause is determined off of yield curves from bonds. So that's why I keep saying bonds, because bonds are telling you this. Let me know what you guys think about this down below in the comment section. Again, like I said in the beginning of this video, this has big implications for stocks that we own and talk about here on this channel. Collateral crisis would probably be the word of the day, or collateral or crisis or credit, or any of those words are going to become a lot more important over the next couple of months. And I'll keep you guys up to date with all of this information that happens on a day-to-day basis, as well as what the future looks like as well. So that is it, guys. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Thank you for watching, and I will see you in the next one.